It's a truism that what goes up must come back down again. Now, when we use leverage or we borrow money for our investments, it means that when things go up, they go up faster. When things come down, boy, can they come down incredibly quickly. So leverage can actually accentuate or exacerbate or make much worse the effect of a bear market. Now that has a couple of really important points. Number one, it means that as prices come down, the leverage is going to make it seem faster and stronger and more powerful for us. So as an investor, emotionally, that's going to hit us much harder, much faster. And that's an important point to remember. Number two, as prices come down, if we've used leverage, it means they're going to come down further than they would otherwise. Now, what that means is it means it's asymmetric. If it comes down 50%, it means that we need to double our investments to actually get back to where we were before. Let's think about that. If investments come down 10%, they need to go up about 11%. So a $100 investment decreasing to $90 has to go up about $10, or about $10 on that 90, about 11%. If prices come down from $100 to $50, they need to go up another $50. That is a 100% return on investment to get back to where we were before. That is going to be painful. That can be very slow. And if we are in a hurry, we might also take on additional risk that we don't otherwise want to take on in order to try and make up that investment gain. And so leverage has that double effect there that can be quite damaging to us. Now, it's also really important to note that there's a couple of elements here where leverage can be hidden. Number one, where I think some investors get caught out, is the leverage within a closed-end fund. Now, closed-end funds, or CEFs, are treated differently to some of the other investment vehicles. They can actually borrow some additional funding and money for their investments. Now, they're limited to how much they can take on, and in fact, it doesn't sound like a heck of a lot. They can take on perhaps another 30% investment, 30% loan to actually leverage up those investments. And again, it means that they can do really well when times are good, but when times are bad, rather than say going down 30%, though, because of that extra 30% borrowing that they've taken on, that 30% decrease in the value of the underlying assets can translate into perhaps 40% in the value of those assets. But it gets worse than that. Because a closed-end fund can trade at a different price to the underlying value of the assets, that 40% decrease in the value of the underlying assets can be exacerbated as investors become spooked, they become worried, they become concerned, they panic, and they can begin to push that value of the price, the share price for the CEF, down much faster, much further than that 40% decrease in the value of the assets that they might otherwise experience. And so that disconnect with a CEF, with closed-end fund, can mean that prices disconnect and actually decrease at a much faster and steeper rate than the underlying value of the assets, which are also leveraged. So we've almost got a double effect there that can be quite negative for CEF holders. Now, another issue that I see there is there's a little bit that you can borrow on margin, and some companies will let you borrow quite a lot on margin as the broker. That can sneak up on you. Again, when times are good, you feel like a genius, but when times are bad, that margin can cut and make you bleed so much, so fast, so quickly. Try not to be in that position. Try to moderate the amount of leverage that you use when you're buying on margin, and you could perhaps look to the CEFs as a guideline. You shouldn't be taking on very much margin at all. You probably want to limit that at 30%, and for many investors as well, I think even 30% is a huge amount of risk to be taking on with a margin investment. There are, of course, other vehicles out there in the market as well, and one that I've seen talked about quite a lot recently is the exchange-traded notes. Now, I don't want to get too much into the mechanics here, but again, these can open you up to a huge amount of leverage and risk. So rather than even being capped at 30%, I've seen exchange-traded notes that look like normal investment vehicles, but with a huge amount of leverage and risk, perhaps 50% or more. Another related issue is, for example, a ×3 fund. So there are some funds available, instead of, say, tracking the S&P 500, they're designed to capture the movement of the S&P 500 the refold in that one day. Now that again can be great when things go up, but remember, the bull goes up the stairs, the bear goes out the window. So as stock prices increase with, say, a triple leverage fund, it's going to decrease very, very, very rapidly. Now that's important because as stock prices decline maybe 20%, as we've sort of seen in the recent past, that 3 times factor can make that 20% decline seem much, much bigger and could hit, say, 60% decline, or 3 times 20. And that, my friends, is pain and suffering you do not want to see. So, wrapping all this up, what do we need to do? I personally think look at your underlying investments carefully to see whether or not there is any leverage being used, and then look to see whether or not you have a huge amount of leverage over your entire portfolio. If, for example, you have some of the closed-end funds with leverage, and you have some of the leveraged ETFs or a leveraged ETN, it is entirely possible that you actually have more leverage in your portfolio than you realize. Check this out. Let me know down in the comments below. Do you actually hold quite a lot of leverage within your portfolio?